If you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall, and here with me today is Rob Burnett, manager of the Neptune European Opportunities Fund. Hello, Rob.
Hi.
So we're here today to talk about how macro events influence the markets. In particular, we've had an ECB decision this week, cutting interest rates. Stock markets did react. Is this something that we should take into consideration when investing?
Definitely, monetary policy and macroeconomic events are enormously important for markets. And one of the simple ways of understanding the transmission between monetary policy and the real economy is the interest rate for an economy. And so if interest rates go down or if loan rates go down, people can borrow more cheaply, they're more incentivized to spend. That can obviously catalyze a stronger economy, and therefore these things are extremely important and should be considered very carefully.
Because GDP is not always a good indicator of whether markets are going to do well. In particular, if you look at China, despite the fact that China's GDP has slowed, it had some periods of underperformance, but you're saying there are other key macro indicators which perhaps do have an influence on markets.
GDP is a lagging indicator. The market's normally up to speed with what the GDP is, in the coming quarter. The market's more preoccupied with the rate of change of the economy and the momentum. And so in this example of the ECB cutting rates recently, that's going to have an impact in affecting the rate of change of the economy tomorrow versus, current output. And that is what preoccupies markets more, the rate of growth in the next 6 to 12 months. And we would say GDP isn't necessarily correlated with equity market returns, but long-term GDP in the next 2 to 3, 4 years is definitely, a powerful sort of source of support for markets if an economy is growing strongly.
So using the indicators that we have at our fingertips today, what would you say investors can expect from Europe in the medium term?
We're pretty constructive on European equities for many reasons, not least because we do think the economy is going to continue to recover. The major element of the sort of turning point of the economy was really about a year ago, when a lot of the Eurozone pulled out of recession. And what we've had in the last 12 months is a slight stop and start kind of setup, rather like we had in the UK about 3 or 4 years ago. And funnily enough, the European Central Bank is carrying out policy quite similar to the UK did a couple of years ago. And we know what happened in the UK in the last 12 months. It's rebounded quite strongly, as is the housing market. We anticipate a similar outcome in Europe. And so, we do think the setup is very constructive for the economy and for markets right now.
And when a region is experiencing this economic recovery, are there certain sectors that people should be looking out for which will benefit more?
Yes. In Europe today, the most cyclical sector, in fact, you can almost call it hyper-cyclical, is the banking sector. And so just as this was the major area to avoid in the crisis, and it suffered enormously, it is the major area to benefit from a better economic outcome. And again, going back to the ECB, the policy announcements yesterday or recently were especially beneficial for the banking sector. So we would recommend focusing on the banks as the major sort of beneficiary of this improvement within the European economy.
Because they're basically going to be paid to lend now, aren't they?
Yes. Almost. The way to understand it, I would put it, is that the ECB is going to give them very cheap funding. So normally, how does a bank generate funding? It gets it from its depositors, and it pays interest to those depositors. And of course, that still takes place. At the moment, most European banks pay around 2% interest on a term deposit. The ECB's giving the money at 15 basis points, as in 0.15%. And so this is a massive reduction in their cost of funding, and therefore it will enable them to lend quite cheaply to the economy. And so this is especially powerful for the banking sector, this source of ECB money.
And other than banks, would you perhaps have a bias towards domestically focused stocks? Because as that domestic economy rises and improves, they will also benefit? Yes.
In the last decade, we had invested with a focus on companies with a global reach, kind of the companies exposed to global growth, whether it was Chinese growth or Brazilian growth or even US growth, we had a predisposition to invest in those companies because the outlook was exceptionally strong. Today, there's an incredible valuation opportunity, that is a discount in companies exposed to Europe. They've done poorly in the last 5 to 7 years, and as a result, the equities are very cheap and expectations are pretty low. And so where do we look for outsized returns today? It is exactly that domestic exposed kind of company with high sales to the Eurozone. That's where we think most of the upside will be located in the coming years.
Thank you very much.
Pleasure.
This is Emma Wall for Morningstar. Thank you for watching.